The screen blinks as Alex stares at the stock chart of Technova, a software firm known for steady earnings. It's early May, and the market is in turmoil after a competitor's unexpected earnings miss. Technova shares drop 5% after hours, and as the estimates slide, Alex identifies a potential entry point. He's capitalized on similar dips before, buying into downturns that led to rebounds. He types rapidly on his trading platform. The recent earnings miss adds to the caution sweeping through the tech sector, but Alex's previous trades have yielded significant returns. With the price hovering around $90, he places an order for 200 shares, eager to leverage the decline. The execution is smooth, and his order fills almost instantly. The next day, the market opens lower. Technova struggles to hold its ground, sinking to $86 amid broader sector weakness. Investors react hesitantly as mixed news emerges. The Federal Reserve hints at tightening, raising concerns about slowed growth in tech. Alex monitors the price fluctuations but stands firm. He's witnessed rebounds in similar situations. Instead of selling, he sees an opportunity to double down and orders an additional 300 shares. With his average cost basis now at $88, uncertainty grows in the market. Yet, he feels a surge of conviction with each transaction. Technova boasts a loyal customer base, and its growth trajectory seems well supported by recent innovations. Later that week, news breaks. A tech giant announces layoffs, adding to the market's volatility. Technova drops to $82, and analysts scramble to revise forecasts as the shares tumble. Panic spreads through trading patterns, but Alex hovers over his keyboard. This is where he thrives, buying during dips. Trusting his strategy, he acquires another 200 shares, increasing his total to 700 at an average cost of $85. Days pass. Technova's stock oscillates around key support levels, but struggles to gain momentum. Then, disaster strikes. The company reveals dismal customer acquisition metrics, and the stock crashes to $75. Reports of a sector-wide correction flood the media, and Alex watches as his position turns deeply red. Still, he adheres rigidly to his strategy. He places a limit order to buy another 300 shares, raising his total to 1,000. As the flood of orders stacks up, he monitors the charts, uncertainty creeping in with each tick. He's averaged down in turbulent waters before, but each downward movement only amplifies his concerns. Technova slides to $70, and management delivers another grim announcement regarding earnings growth. A wave of selling sweeps through the sector, dragging Alex's position down further. His hands quiver as the trading window nears the close. He knows he should reevaluate, yet the fear of missed opportunities paralyzes him. Instead of hitting sell, he places one final order for 200 shares at a staggering $65. The trades execute, and he now holds 1,200 shares at an average price of $75. When the market opens the next day, the losses deepen. Technova plunges to $60, driven down by analysts issuing widespread downgrades. The hope for a rebound fades as heavy selling overwhelms the market. Within hours, Alex's portfolio shrinks to a fifth of its original value, a staggering $90,000 loss on an initial investment of $150,000. As the closing bell rings, the screen shows his holdings, 1,200 shares at a final market price of $60. The total value drops to $72,000. Each click of the mouse mirrors his downward spiral, a complete reversal of a strategy that once thrived. What was once a confident approach has transformed into a cautionary tale, exposing the vulnerabilities in an unforgiving market. In the end, Alex's downfall wasn't just about the market's volatility. It stemmed from a rigid adherence to a strategy without adapting to the changing landscape. A disciplined approach would have prompted him to reassess the fundamentals of Technova amid the turmoil. Instead of doubling down on a losing position, a more measured decision could have mitigated his losses. Understanding when to step back is just as vital as knowing when to buy. In investing, it's not just about conviction, it's about clarity and adaptability.